Hello students. Yes, so in this video I'll be explaining on one of the types of systematic risk, that is interest rate risk. Again, this is one of the important types of risk that you will have to understand properly, right? So interest rate risk, what does this kind of risk talk about? Again, this is one of the forms of systematic risk where it is the potential for the investment losses that would result from a change in the interest rates. Of course, see, what you have invested, that becomes your capital, right? Your capital outlay, where in return what you are going to get, that becomes your return. In case if you have kept it in the bank, you are gonna get the interest. So that's what I'm talking about. If you are going to get in form of debentures, invest in form of debentures, what do you get? A fixed rate of interest, isn't it? So due to this, a factor called as market risk, which is uncontrollable in nature, where the fluctuations are the point where you have to consider obviously the investment losses that would result from a change in interest rates. See, if like interest rates, for instance, the value of a bond, right? For bond there will be a fixed income investment where it will decline. The change in the bonds price given a change in interest rates is called as a duration. So it all depends upon the price as well. Here what is going to happen, the interest rate risk is that, see, here there will be a volatility, there will be a kind of probability of the decline or the downturn in the value of an asset, that which results from the unknown or unexpected fluctuations in interest rates. And interest rate risk, it is mostly associated with the fixed income. Like example, classic example would be the bonds rather than with the equity investments, because in terms of equity preference, what you are gonna yield, you as an investor, that is as a shareholder, you are going to get the dividend. And what is now dividend? Dividend is a portion of profits which is shared among the shareholders of the organization. But when it comes to bonds, the debentures, everything, this is all associated with a return called interest. So interest rate is one of the primary drivers of a the bonds price. That's how it is going to work. So the current interest rate and the price of the bond, it is going to demonstrate in terms of inverse relationship. See, when the interest rate increases, the price of the bond decreases. You will not find it. There is no such thing. You are gonna find it, right? So how you are going to mitigate, there's something called as a diversification sign, right? So if a bond holder is afraid of interest rate risk, that can adversely or negatively affect the value of his portfolio, he can diversify, right? He can diversify his existing portfolio. How? He's gonna add the securities whose value is less prone to the interest rate fluctuations. Example, he can go for equity, he can go for preference, where he will not face the risk of interest, isn't it? But in case if he has borrowed from his through on behalf of his organization, what is going to happen? He is liable to pay the interest. And if the investor has bonds only in form of his portfolio, he can diversify the portfolio by including a mix of both the long term as well as a short term bonds, right? And there's one more way, hedging. And now what does hedging talk about? Hedging is something where you can mitigate, where you can minimize. Say, completely you can't avoid, but somewhere you can cut down, somewhere you can minimize it, right? So the interest rate risk, it can also be mitigated through various hedging strategies. See, these strategies, they generally include the purchase of different types of derivatives. Like in order to mitigate it, you have something called as options, you have futures, you have forwards rate, the agreements, you have swaps. We have learned all these concepts under the different marketable securities, how it can be dealt, how the delivery date will be, how the strike price, how the exercise price can be framed, and how the things are going to work under this particular avenues, right? So interest rate is something where it is the exposure of the institution's financial condition, that where it is going to face the adverse movement in the the interest rate. So accepting this risk is a normal part of the banking, and it can be an important sources of incurring the profits, isn't it? So when you have invested on that, you are going to yield the return. The return is in form of the interest, and it is going to increase in form of the shareholder value as well, right? So the effective risk management that would maintain the interest rate risk at a prudent levels is essential, very essential, to have the safety and soundness, it is effectiveness of the banking institutions. What are the various sources you can obtain this particular interest rate risk? Is that, see, interest rate risk basically, it is like the difference in the timing of the repricing of the bank assets. It can be the liabilities, it can be OBS, which is nothing but the off balance sheet instruments, right? See, repricing mismatches are the fundamental to the business of banking, and they generally occur from either borrowing short term to fund which is of a long term assets, or borrowing long term to fund short term assets, right? So basis risk is that when the adjustment of the rates which is earned and paid on the different instruments, which is imperfectly it is like correlated with, otherwise similar repricing characteristics are going to happen. See, like you have treasury bills, 3 months, have 6 months, 9 months. This is something like 3 month treasury bill versus a 3 month LIBOR, right? Which talks about the London interest rates where they are going to do it, right? So how the things are going to work under here? See, there are four key elements of a risk management program which is associated with the interest rate risk, right? So there are certain policies and risk limits, a measurement and reporting, controls, audits, the oversight about the aspects, right? So the most important thing is that if the interest will increase, then the people will take less loans as they have to pay higher amount of interest, isn't it? See, if I give you a chance, I'm going to where I'm the bank, I'm going to offer you 20,000 rupees of a loan. On top of that, I'm going to charge 8%. Would you definitely come and borrow from me? Or there's one more bank who is offering the same 20,000 rupees at 5% of interest. Would you go for that? Obviously. So it is something like when when the interest what you're going to charge on the loan, if it increases, then definitely the public will take less loans, borrow less loans, as they have to pay, yes, the higher amount of interest. See, as we can take the example that if interest increase, then home loan will reduce, right? And as there will be no benefit to the people, and the real estate market can go down as well, and the activities which are related with this market will also downturn, that is it will also come down. So that's how the things can adversely affect under this particular aspect called interest rate risk. So something interest rate is that the risk that which out arises for the bond owners due to the volatility, due to the fluctuating interest rates. And how much interest rate risk a bond has depend it depends upon how sensitive it is with the price to bring in the changes in the interest rate market, right? So the sensitivity is associated with this particular aspect is really very very important. So it is something that the risk that interest rates will arise and reduce the market value of an investment, and as well as it always considers the long term funds, like you have bonds, you have debentures, isn't it? So that's how it is going to work. See, such as like short term securities, the treasury bills, where there is a government intervention, where government is going to do it on behalf of the RBI, where the maturity period you have 3 months, 6 months, 9 months. And with respect to the risk, of course you can neglect that particular risk, isn't it? So now how it is going to like happen here, that they are influenced much less when it comes to the short term securities. They're much less by the interest rate movements, and the common stock prices they are also affected by the changes in the interest rates. And although the linkage is less clear than is the case with debt securities and the preferred stock. That's how the things are going to work with the interest rate risk. So to sum up it, what is this interest rate is all about, I'll just give the conclusion part of this particular interest rate, like how it is going to work. See here, interest rate it is something where the bond prices also change, and the bond investors can also, unexpectedly gain, or they can lose the money as well. That's how the interest concept is going to work. Then apart from that, what you have to understand is that, see, the risk of losing money, because interest rates move up or down, isn't it? See, the value of the bonds, with respect to the portfolio, what is going to happen? It can, uh, it can be reduced if the interest rates, it moves higher, and the value of interest paid on the bonds, it also remains set, isn't it? So whenever you are making a decision with the interest, that is which is subjected to the macro, that is with the economy, this is and it is going to have an adverse impact on the portfolio. It can be in terms of bonds, whatever the interest you are going to incur, there can be a fluctuations, right? So this is all associated with the factor called the interest rate risk under systematic risk, which is uncontrollable. It is not diversifiable, undiversifiable in nature.